In a previous lesson, we presented various indicators regarding growth. In the current lesson, we will discuss some rates measuring the rise of prices, inflation. We'll make a start with the Consumer Price Index, the CPI. The most well-known measure for the rise of consumer prices is the CPI rate. It's a measure of the average change over time in the prices paid by consumers for a basket of consumer goods and services. The annual rate of change in the CPI is usually referred to as the inflation rate. The rate is measured on a month-on-month basis, on a quarter-on-quarter, and on a year-on-year basis. We have already discussed the importance of inflation in the previous lesson and the implication it has for monetary policy. Hence, an acceleration of the rate beyond market expectations tends to provide support for the currency, while a deceleration beyond market expectations or even a contraction of prices tends to weaken it. Then we have the core CPI, which is the same as the CPI, but it excludes energy and fresh foods. Because food and energy prices are relatively volatile, they can distort CPI readings. For example, the price of oil may be manipulated by cartels of producers such as OPEC, or can be politically weaponized, while fresh food may be sensitive to weather conditions and natural disasters. Thus, some analysts and investors prefer to focus on what they perceive to be the core or underlying rate of inflation. Once again, a possible acceleration of the rate tends to provide support for a currency and vice versa. Harmonized Index of Consumer Prices, HICP. In the euro area, consumer price inflation is measured by the HICP. The term harmonized denotes the fact that all the countries in the European Union follow the same methodology, a result of the adoption of the euro as a currency and the ECB as a central bank. Overall, the rate is considered superior to the national CPI rates of the member states of the Eurozone, as it makes them directly comparable with each other and allows the calculation of the inflationary pressures in the Eurozone as a whole also being comparable. A faster than market's expectations rate tends to provide support for the common currency and vice versa. Core personal consumption expenditure, or else core PCE. The core PCE price index measures the prices paid by consumers for goods and services without the volatility caused by movements in food and energy prices, revealing underlying inflation trends in the US economy. It is considered as the Fed's favorite inflation measure, and along with the CPI rate, are considered the key inflation metrics for the US economy. Thus, an acceleration beyond market expectations could provide support for the greenback and vice versa. Producer Prices Index, the PPI, is a different ballgame. It still measures the rise of prices, but for producers, not for consumers, like the previous rates mentioned. It measures the average change over time in the selling prices received by domestic producers of goods and services. As mentioned, PPIs measure price change from the perspective of the seller, as opposed to the CPI rate, which measures price changes from the consumer's point of view. And the importance also relies on the idea that should a business suffer continuous price increases over time, at some point it will have to roll over the price increases to consumers. An acceleration of the rate beyond market expectations is expected to provide support for a currency, while a deceleration or contraction could weaken it. In the next lesson, we will discuss indicators regarding employment.